So I invest for dividends. I think that style of investing is one, very effective historically speaking, but two, psychologically, it's a very fun and addictive way to invest. If I come over to the activity page of my brokerage, we can see that just over the past couple of days, Divo paid me a dividend of $24.89, XYLD paid me a dividend of $11.51, and together they bought more shares of XYLD and VOO. And just yesterday, JEPI paid me a dividend of $38.17, and again, that was immediately reinvested back into XYLD and VOO. And the reason why I view this as being super fun and addicting is because you have a physical log of all of the progress and payments that you receive, and you can see how it's being reinvested and compounding over time. So because my dividends are buying more of XYLD, next month, when XYLD pays me again, the dividend payment is going to be even higher. And when it comes to growth investing, the way that you measure progress is completely different. And one day you could be down, the next day you could be up. It's fully dependent on other investors. Now, when you zoom out over many years, growth investing does have pretty solid returns. But so does income and dividend investing. The major difference is that you're realizing actual gains along the way. In fact, because I'm such a fan of having cash flow within my portfolio, when it comes to my crypto investments, I hold them in an account like BlockFi, which pays me monthly interest off of my assets. So as I'm holding these insanely volatile growth assets that one week could be up 10%, the next week down 30%, at least along the way, I am realizing some gains in the form of interest payments. So on November 30th, I was paid $108 in interest off of my crypto. A month before that, $85, a month before that, $55, the previous month, $106, and all of these payments are compounding and giving me additional returns while I wait for my crypto to hopefully appreciate over time. In fact, in the near future, because I'm such a fan of this, I'm going to be transferring most of my crypto over to Celsius because they pay a higher interest rate. And that's going to help this number increase rather fast. But I'm going to make a dedicated video on this whole thing pretty soon, so if you guys want to see that, subscribe to the channel and stay tuned. Okay, but the major thing I want to talk about in this video is why, as a person that likes to invest for dividends and income, do I not invest in Dividend Aristocrats for the most part? So if I come to my dividend assets, I have ETFs like Divo, JEPI, and my custom call ETF. Now, there definitely are some Dividend Aristocrat names within these ETFs, but it's not the majority by any means. Okay, so let's do a quick background on what Dividend Aristocrats even are. So nobl is an ETF that holds S&P 500 Dividend Aristocrats, which are high-quality companies that have not just paid dividends, but have grown them for at least 25 consecutive years. And for the most part, these companies are household names that everybody's familiar with and probably uses their products. And nobl's strategy of investing in these Dividend Aristocrats has demonstrated a history of weathering market turbulence over time by capturing most of the gains of rising markets and fewer of the losses in falling markets. But from this statement, we can learn a few things. So this ETF tends to lag the market and only capture most of the gains, but when the market is going down, there's greater stability. And looking at the Dividend Aristocrats side by side against the general market, we can see that it is true that there is slightly less volatility, but they also have slightly less returns in the overall market. And this is both the reason why people love Dividend Aristocrats and hate them. So here's a list of some of the actual companies that are Dividend Aristocrats. We have Genuine Parts, we have Procter & Gamble, 3M, Coca-Cola, Johnson & Johnson. Again, most of these are household names that everybody is at least somewhat familiar with. Now, the issue I have with most Dividend Aristocrats is that they like the market in terms of growth. Now, this is definitely not true for all names, and I will show examples of some that I like later on in the video. But let's take Aflac for example. We can see over the past 1 year, it is up 20%, and over the past 5 years, it is up 62%. And this company is super boring and stable, which is what a lot of dividend investors like about this company. So what they do is they sell different kinds of supplemental insurance. And when it comes to their dividend, they pay out a 2.87% dividend with a healthy payout ratio, and they're growing the dividend almost 10% per year. So in terms of stability, income, and predictability, this is a great choice. But the reason why I don't like it is because it's too predictable and too stable. So this is their total revenue year by year, and we can see just how flat it is. There's not much growth at all. As we saw, the payout ratio is very low and healthy, so this is more than enough income to support the dividend. But when I evaluate investments, I always have to factor in opportunity cost, because if I put $1 into company A, that's $1 I cannot put into company B. So it's true that the flat revenue can support a dividend well into the future, but on the flip side, it translates to extremely weak price appreciation for the overall asset. And that's why when benchmarked against the overall market, it has underperformed quite severely. Kimberly-Clark is another example of a Dividend Aristocrat that I'm not a huge fan of in terms of an investment. So these are the products that they make. Their quality, it's a household name. I'm sure you have these products in your house right now. This is the dividend information. So the yield is actually pretty high, 3.34%. Payout ratio is a little bit on the unhealthy side, but the growth rate is a pretty modest 4.29%. Right in line with inflation. But it seems like this company has a saturated market. Everybody that wants to buy tissues, diapers, and all the products this company sells, they already do so. And that's why the revenue and the growth of this company has flatlined. We can see over the past 1 year, it has been completely flat. And over the past 5 years, it's up only 19.26%. So I want to highlight a clear distinction in what I'm trying to say here. So as a company and the products that this company sells, I think they're very high quality. They're ubiquitous, a household name, and their products are used by millions of people. And their revenue can support their dividend well into the future, as it has done in the past 49 years. But in terms of growing into something bigger into the future that can generate you both dividends and capital appreciation, in my opinion, companies like this aren't your best choice, especially when you factor in opportunity cost. And AT&T is my final example of another Dividend Aristocrat that I just do not want to ever invest in. So ever since AT&T sold off their media branch, namely HBO Max, I have completely lost interest in this company because that was the only way, in my view, that this company could grow more in the future. So now AT&T is fully focusing on their wireless business, but again, the market is almost fully saturated here in the US. So with fewer net additions on the table, AT&T and its rivals Verizon and T-Mobile will have to focus on reducing subscriber churn and increasing average revenue per user. So that's the only growth path these companies have. They try to reduce cost and churn, and they squeeze every dime out of the existing users that they have. And again, taking a look at their total revenue, it is completely flatlined, and there's just no way for this to really grow substantially in the future unless they change their business model. So what I'm trying to say is you don't have to pick between consistent dividends and price appreciation. With the proper investments, you can get both. And in my opinion, that's what you should be striving for, because the total return of an asset is ultimately what matters most. And there definitely are some Dividend Aristocrats that meet that bill. The first one is PepsiCo. I think this is a very high quality company. So just like with most Dividend Aristocrats, you guys are very familiar with most of the products this company makes. So of course they have Pepsi's, they have Tostitos, they have Quaker Oats, they have Mountain Dew, Cheetos, Doritos, and many more. They have a strong dividend, and they're almost a dividend king with 49 years of consistent dividend growth. Now this is definitely not a growth name by any means, but considering its size, management is doing the right things in my opinion. They're making the right mergers and acquisitions and launching new products to continue to grow. And we can see that represented in their total revenue. So in 2016, they had $62.8 billion in revenue, and in 2020, $70.4 billion. And because of that, you get decent price appreciation of 14% in the past 1 year, along with that stable dividend payment. Another Dividend Aristocrat that is actually one of my favorite just overall companies on the stock market is Lowe's. And of course, they focus on home improvement, and they have a duopoly with Home Depot. And we're taking a look at the revenue of this company. They are experiencing a healthy amount of growth, going from $65 billion in 2017 all the way to almost $90 billion in 2021. Their dividend is a little bit on the low side, but they're growing it on the faster side at 17.32%. But the price appreciation of this asset has been 67.45% just in the past 12 months, and over the past 5 years, it has outperformed the market up 246%. So I think this company has it all. It's a Dividend Aristocrat that's a household name. Everybody knows about it. It sells high quality products and services. It has an extremely safe and fast growing dividend, as well as extremely competitive price appreciation due to all of its growth. So I'm not a fan of the overall nobl ETF, which tracks the S&P 500 Dividend Aristocrats, because most Dividend Aristocrats just don't offer enough growth and good overall total returns. Now, they do have other positive characteristics like lower volatility and very consistent dividend payments, so depending on the investor, it could be a great choice. But an alternative that I really like is Schd, which uses the Dow Jones US Dividend 100 Index instead. So this index has somewhat similar requirements of having a minimum of 10 consecutive years of dividend payments, but it puts a lot of weight on other metrics like free cash flow to debt and return on equity. And because of that, in comparison to nobl, Schd offers better total returns along with a very similar dividend. And when it comes to investing, as mentioned, the number one thing is the total return. Nothing exists in a vacuum, so you always have to factor in opportunity cost. And when it comes to having stable dividends along with decent price appreciation, in my mind, SCHD clearly beats out the Dividend Aristocrats. But that's just my opinion. Let me know in the comments down below what you guys think on the topic. I'd appreciate a like on the video and a subscribe. It helps me out with the YouTube algorithm a lot, and it's greatly appreciated. But regardless, I'll see you guys in the next one.